Hi CS students, let's revise CA Final AFM Advanced Capital Budgeting Decisions Chapter 3 Practical Question 12. The easygoing company limited is considering a new project with initial investment for product survival. It is estimated that IRR of the project is 16%, having a estimated life of 5 years. The finance manager has studied the project with sensitivity analysis and informed that annual fixed cost sensitivity is 7.8416%, whereas cost of capital sensitivity is 60%. So in this question they have given IRR, then sensitivity of fixed cost, and then cost of capital sensitivity, and some other information like PV ratio, variable cost, then annual cash flow. And they are asking us to calculate initial investment, net present NPV, then annual fixed cost, estimated annual units of sales, and break-even units. And they've given cumulative discount factors, so we have to use this only. And they told to ignore depreciation on initial investment and impact of taxation. So whatever the sales minus variable cost, the contribution minus the fixed cost will be the annual cash flow, and there will not be any tax benefit on depreciation, and we should not reduce any taxes here, as they clearly told to ignore. So going to the solutions, first part we have information of sensitivities, which is the resultant. In previous questions we used to find out this sensitivity. In this question they have given already how much it is sensitive, and we have to reverse work to calculate the respective values. So cost of capital, they have not given the actual percentage, but they have given sensitivity. In this case of reverse calculation questions, we have to use break-even approach, as when the NPV is 0 and the cost of capital is sensitive up to 60%. Same case goes with fixed cost, same case goes with IRR. As we already know, at what percentage the NPV will become 0, at what discount rate the NPV will become 0 is our IRR. And going further to the requirements, first step is to find out initial investment of the project. Since we have the annual cash flows, wherein we know that the initial investment will be, which is a negative value, then annual cash flow, then multiplying with discount rate, we will arrive at NPV. In this case, since the NPV is 0, and then if we find out this discount rate, then we can arrive at the initial cash flow. So the cost of capital we have taken. So based on the cost of capital sensitivity, we have to figure out the initial investment, because we need the discount rates. Before going to the cost of capital, as we already know, IRR is the rate at which NPV will become 0, and for initial investment also we can apply the same logic. Since our NPV is 0, if we take this IRR percentage as the cost of capital, then we can arrive at the initial investment, and initial investment will not change. So 57,500 is the annual cash flow multiplied by annuity factor, and they have given the estimated life of 5 years, so 16% at 5 years. So they have already given cumulative factors for 5 years, wherein 16% the rate is 3.274. so if we multiply 57,500 into 3.274, we will get a value of 1,88,255. then so our initial investment also will be the same. Going further, they are asking us to calculate NPV. So NPV is simple. Before going further to NPV, we need to calculate the cost of capital. For calculating NPV, we need a cost of capital, as we have initial investment of the project and we have annual cash flows, but we don't have the discount rate at which we have to discount it, but we know the sensitivity is 60 percentage. So 16 percentage, at 16 percentage the NPV is 0, so 16 percentage divided by 160 into 100, we will get the cost of capital, which will come up to 10 percentage in our case. So 10 percentage is the cost of capital. Then using annuity factor for 10 percentage for 5 years, which is 3.791, we will get a NPV of 29723. Then going further, we need to calculate annual fixed cost. For annual fixed cost, now if we are keeping NPV as 0, keeping the fixed cost as the variable, we have initial investment and we have the cost of capital also, but we don't know the fixed cost. So we have the sensitivity also 7.8416. So in this we are taking an approach of, since we know the NPV is 29739, we'll keep the NPV and then we'll keep the annual cash flow as X, keeping the change. So whatever change is happening, that change will be the fixed cost change. That is the assumption here. Let X be change in fixed cost, which makes NPV 0. If we keep fixed cost, then annual cash flows, we have to keep it as X. We are arriving at a value of 784190. If we take 10 percentage cost of capital and then 10 percentage cost of capital and NPV of 29723, which we found out previously, we will get the cash flow as 7841, which is the change. So this much change will bring my NPV to 0. So that change we are keeping as fixed cost change also. So we know the percentage change is 7.8416. Now we know what is the value of change and we know the percentage of change. Keeping these two things, if we multiply, so if we keep original fixed cost as Y, so Y original fixed cost into the change percentage will give me the change amount. We know the amount, we know the percentage. When we reverse calculate, we will get the fixed cost. So in our case, since the change in amount is 7841 and the change in percentage is 7.8419, we will get the fixed cost as 1 lakh. So now we got fixed cost also. Going for the estimated annual units of sales. Here since we know the variable PV ratio is 70 percentage, which signifies our PV ratio is 70 percentage, so the contribution is 70 percentage here. Here it is 70 percentage and this signifies 30 percentage and our sales unit will be 100 percentage. Now since this 60 is at 30 percentage, if we divide it by 60 divided by 30 percentage will give our sales, which is 200. So 200 per unit will be the sales per unit will be 200, and keeping 200 into X, because the annual units of sales we are keeping it as X, and then we will get this value of 140X. Now going further, we know fixed cost is 1 lakh and we know that cash flow, annual cash flow also 57,500. Keeping this, we will get the annual unit of sales, which is coming up to 1125. So we got this estimated annual units also. So break even units they are asking, which is nothing but fixed cost divided by contribution per unit, which we already know. Fixed cost we have calculated 1 lakh divided by contribution also we calculated here 140. So 714.285, which will be the break even units. So ICAI solution also same. For estimated annual units, they have followed a simpler approach. uh, we can use this also, or this will be easier. This you can use it like a format, because as we know, sales minus variable cost, contribution minus fixed cost will give us profit. You can use it as a format for all the questions, then arrive at any value. If you want fixed cost, then keep x, fixed cost as x, and then plot all the other values. If you want cash flows, then keep here as x. If you want sales, then keep there as x. So it's work. Thank you.